Stand at the end of your street and look down the row of houses. Somebody has already decided what every roof on it is worth. In 2024, State Farm told about 30,000 California homeowners it would not renew their policies. Most of those people blamed State Farm. They were looking at the wrong rung of the ladder. The company on your policy is rarely the company that decides. You think insurance is two parties, you and one company. It is not. Your policy is the bottom step of a ladder. That ladder climbs all the way up into the money markets. Almost nobody who pays a premium has ever seen the top of it. So who is standing up there? Step 1 is you. You pay every month. If your house burns, your insurer pays the claim. That works fine when one house burns. The premiums of the neighbors quietly pay for it. It stops working when a whole town burns on the same afternoon. Then there are no untouched neighbors left to pay. So your insurer buys insurance of its own. That is called reinsurance. Another company promises to cover your insurer once the bill gets past a certain size. Think of a shared bill at a long table. Your insurer covers the first round. Somebody bigger, sitting further back, covers the rest of the night. That is step 2. How big is that size? Look at the California Fair Plan. It is the state's insurer of last resort, the one you land on when nobody else will take you. It has to pay the first $900 million of a wildfire itself. Only then does its reinsurance start paying. $900 million before the second rung even wakes up. And that plan keeps growing. Between late 2024 and the end of 2025, the number of homes on it grew by 44%. It now covers more than 660,000 properties. Not one of those owners chose it. They landed there because somebody above their insurer stopped saying yes. Step 3. The reinsurer buys cover too. That is called retrocession. Insurance for the people who insure the insurers. Each rung carries the piece below it and hands the rest upward. Step 4 is the strange one. Above all of that sits the money market itself. Insurers now borrow from investors using something called a catastrophe bond. The deal is simple. You lend money and collect interest. But if a named disaster happens, you lose that money and it pays the claims instead. It is a bet on the weather made with somebody's savings. By the middle of 2026, there were about $65 billion of those bonds outstanding. So who is lending it? Pension funds, sovereign wealth funds, university endowments. In December 2025, the California Fair Plan sold one of its own, called Golden Bear Re. $750 million, the largest wildfire bond ever sold. 2 months later, it sold $400 million more. So a fire in the hills above Los Angeles now reaches into a retirement fund on the other side of the world. Now here is the part that does not behave the way you would expect. You would assume your bill goes up because the money above you got expensive. Watch what actually happened. At the start of 2023, reinsurers raised disaster prices by roughly 55% in a single year. Then money came flooding back in, chasing those returns. By January 2026, the same prices had fallen 12%. Across 2026 so far, 16%. That is the steepest yearly drop since the late 1990s. Reinsurers made strong returns 3 years running, and fresh money followed them in. The ladder above you got cheaper, and in October 2026, Fair Plan customers get an average rate rise of 29%. Cheaper at the top, dearer at the bottom. Why? Because your price is not really about what risk costs. It is about whether anybody wants your street at all. Long before any of this, a computer model has already read your address. It weighs the slope, the wind, the dry brush, the age of your roof. 2 houses on one street can come out of it as different bets. Watch what happened after the Palisades and Etune fires in January 2025. The Fair Plan expected losses of about $4 billion. It burned through its own money. It reached its reinsurance. It was still short. By early February, it had already paid out more than $900 million. So in February, it charged its member insurance companies $1 billion. That was the first time it had done that in more than 30 years. Those companies were then allowed to take half of it back from their own customers. Customers in towns that never burned. Customers hundreds of miles from the smoke. half of $1 billion spread thin across a whole state so that one burnt hillside could be paid for. So here's where the dots connect. A town does not become uninsurable on the day it burns. It becomes uninsurable on the day the people above your insurer decide that street is no longer worth carrying at any price you could actually pay. And when the ladder runs out of rungs, the money does not come down from a pension fund. It comes sideways from every other homeowner in the state. You are not only buying protection, you are quietly helping to pay for streets you will never see. If you like knowing how the machinery under ordinary life actually works, subscribe. That is the whole point of this channel. So stand at the end of your street again. Nothing about those houses has changed. What changed is how far up the ladder somebody is still willing to carry them.